BlackRock recommending you have 2% of your portfolio in Bitcoin is absolutely insane, and I will explain why. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. In today's video, we're going to talk about Bitcoin, Bitcoin's allocation in your portfolio, as well as go through some global macroeconomic data. I want to discuss rates as well as the Fed. All right, let's start with the basic idea of a target allocation. You guys might have heard of the term 60-40. This is a term in traditional portfolio management that says people that are on their way to retirement and building a portfolio should allocate 60% to stocks and 40% to bonds. In that allocation, they'll have a little bit of risky assets in the portfolio and some safer assets in the portfolio. These are supposed to balance each other. When one does poorly, the other might do well. And this 60-40 concept is one of the oldest concepts in portfolio management. But over the years, 60-40 has changed quite a bit, especially as we've come into the idea of alternative asset classes. This includes real estate, of course, private equity, venture capital, but most importantly for us, Bitcoin. So in the modern day, what is the right portfolio allocation for somebody that is of working age and trying to build a retirement portfolio? Thankfully, at the Bitcoin Layer, it's not our job to offer individual and specific investment advice, but what we're trying to do is explain why a 60-40 portfolio today for a working age person doesn't make any sense. First of all, because it doesn't include any Bitcoin. And secondly, keeping a target percentage on your portfolio misses the whole concept of that you should not sell your winners. So let's explain that with some basic math. Let's say we have a 60-40 portfolio, 60% stocks and 40% bonds. Let's say that the stock market does really well and the bond market does poorly. So for the last few years, for example, since 2023, we've had back-to-back excellent years in the stock market and very mediocre to down years in the bond market. So a 60 portfolio from the beginning of 2023 to the end of 2024 is going to look something more like 65-35. That's because the stock performance was good and the bond performance was bad, so the amount of allocation to the bond portfolio is going to shrink over that 2-year time horizon. Now, the traditional theory says that investor should sell 5% in stocks and reallocate to bonds, moving the portfolio back to a 60-40. Now, forgetting just the way that retirement portfolio advisors suggest that you manage these portfolios, selling something that has gone up is selling your winner and you're buying the loser. And in that way, if you apply the same concept to Bitcoin, it is an insane way to manage a portfolio. Now, we have this excellent chart that we've borrowed the concept from Unchained and their HODL cave. HODL cave is a derivative of Dhruv Bansal's concept of the HODL wave. HODL waves are a way to visualize the age of coins through time. And by age of coins, I mean how are Bitcoin that have come into existence and were mined and were purchased and were moved into cold storage, how are those coins either sleeping or waking up? The longer they are asleep, it means that you have a long-term holder. And the shorter that they are asleep, it means that you have a lot of trading activity. And we can see through Bitcoin cycles that long-term holders are basically the ones that are selling into a bull market, meaning that as we get into a later and later stage bull market, who are the ones that are buying? New participants. And who are the ones that are selling? Old participants. And so in a bull market, you see long-term holders distribute their coins to new participants. And that usually signals that we are toward the end of that current bull cycle, because you want to see long-term holders, those people, that type of behavior, you want to see them accumulating before you get that signal that the market is going up again. So when we see the market crash after you get all those new participants and Bitcoin's price crashes, what you see then after the crash is that you get these long-term holders, they start acquiring where we get the bottom of the market. And so the long-term holder versus the short-term holder, it's an important concept to watch. This chart is visualizing the performance of Bitcoin over time. So the dotted line that you see, the horizontal dotted line, is no change. Each one of these candle-looking bars, they're not actually candlesticks here. These are the range of returns. So, and then along the x-axis, what you have is the holding period, right? So you have HODL period on the x-axis, and on the y-axis, it's returns. So the bars on the left side of your screen are short-term holders. The bars on the right side of your screen are long-term holders. That rightmost bar, those are holders that have been Bitcoin owners for 10 years. Now you see that go over to the y-axis, and what you see here is that people that have held for 10 years are on average receiving 100 times their original investment. That's that. If you see that 113.7 line on the y-axis, that means that $1,000 invested in Bitcoin is worth $113,000. So if you look at that 113.7 line and you go over, you can see actually that as early as 4.5 year holding period, you actually have some participants that are making 113 times their money. Now that is the obviously the high end of that bar, but if you go further to the right and you see at 10 years, the median and the mean are both well above that 100 level, which means that the average Bitcoin investor that holds for 10 years makes well over 100 times their investment. Now, a basic math question for you guys. If you have a 2% Bitcoin allocation and it goes up 100 times in price, is your portfolio going to look like 2% Bitcoin or 5% Bitcoin or 10% Bitcoin? No, it's actually going to look like 90+% Bitcoin. So if you're using BlackRock's rule of thumb, and I know that they just released this 2% allocation recently, but if you're using that mentality, you will never be able to achieve those compound returns, because every time Bitcoin doubles or triples or goes up 10x, you're going to reallocate, meaning sell Bitcoin. And that's what I mean by absolute insanity. It would be insane to sacrifice the potential for 100x returns. You guys have to understand, BlackRock saying 2%, they just have to do that because it's a cover your ass sort of disclaimer. They can't go out and say, well, you should start at 2% but never sell because eventually your portfolio will become 100% Bitcoin essentially if Bitcoin keeps going up at the current rate. They can't say that. It would bury all their current products, which go from the stock market to the bond market. So BlackRock cannot suggest that you put 10% or 20% or 30, 50% in Bitcoin And it can't even suggest, forget 50% Bitcoin, it can't even suggest that you shouldn't sell. What it means by 2% is that when it doubles, you sell some and you bring it back down to 2% to size it correctly. Well, now I'm going to tell you in the secrets of portfolio management, how do the people that outperform? They make concentrated bets. Is Warren Buffett buying the S&P 500 or is he a stock picker? The stock pickers and those that make concentrated investments are able to outperform if you pick the winner. Well, Bitcoin has given us a clear signal of which asset class is the winner. As Bitcoin's role in the global financial landscape evolves, understanding its potential impact on your wealth becomes increasingly crucial. Whether we see a measured adoption or accelerated hyper-Bitcoinization, being prepared for various scenarios can make the difference between merely participating and truly optimizing your position. This is why Unchained developed the Bitcoin Calculator, a sophisticated modeling tool that helps you visualize and prepare for multiple Bitcoin futures. Beyond traditional retirement planning, it offers deep insight into how different adoption scenarios could transform your wealth trajectory. What sets this tool apart is that it's integrated with Unchained IRA, the only solution that combines the tax advantages of a retirement account with self-custody of Bitcoin. In any future state, maintaining control of your Bitcoin keys remains fundamental to your Bitcoin strategy. Explore your potential futures at unchained.com/TPL. Let's go toward the middle of the graph, okay, the 5-year holding period. You can see actually that in the tail, the minimum amount, there have been some people that have held Bitcoin for 5 years and actually lost some money over some specific 5-year. That's obviously going to be cherry picking. It'll probably be the 19,500 or so 2017 high and the $17,000 or $16,000 November 2022 low off of the FTX Bitcoin price crash. So yes, if you had held from December of 17 to December of 22, you were that one person in time that saw a negative return over a 5-year holding period. But guess what? If you had just held another couple years, gone into the 7, you would have 5x'd your money easily from, or 6x'd actually, off of about 16,000 now we're above 100. So 6-7x times your money off of the 2022 lows after a 7-year holding period. Now we can see that the median and the mean returns for a 5-year holding period are somewhere between 20 and 80 times your money. Okay? So yes, if you are a 1 or a 2-year holder, there's a chance that you're seeing negative returns on Bitcoin. But if you hold for what looks to be about 3.5 years, there's almost nobody that's lost money for a 3.5-year holding period. And if you can hold for, it appears, 7, 8, 9 years, historically, you are in a 100x return position. I don't know how many times I have to even say it to myself just to beat the dead horse here that a target allocation, suggesting a target allocation is really a mistake. And if you look at the other side of the coin and you just think about Bitcoin from a buy and hold perspective, what you're looking at over time is 100x on your money. Now, I believe Bitcoin is heading much higher from where we are today, and I would look at this chart to give you some sense of what that might look like. So at the beginning of 2024, right before we had ETF approval, Bitcoin is trading in the 30 to 40K range. A 10x on 30K is 300,000. And the 10x numbers start to appear right around 3 to 4 years. So from 2024 beginning to 2026 at the end, so that's only about less than 2 years away, a 10x off of the 30K is literally within the context of this chart. So 300K by the end of 2026, which is in about 24 months, is completely in context of Bitcoin's price history. That's the mistake here that BlackRock is making. And you guys at home know that BlackRock is just saying 2% because they have to sell a new product. So they don't want you to have a 0% allocation. But somebody that is known to me, works in the financial industry, asked me recently that, when I interviewed you a few years ago, you said that the target allocation should be this, or this should be the starting point in somebody's portfolio. What is it now? The number is much higher than it ever has been, and it's going to be different for everyone. But I want to show you a chart on volatility that suggests the appropriate allocation for Bitcoin now, combined with this return chart, is much higher. All right, let's take a look at Bitcoin's historical volatility. So this is the standard deviation of daily returns rolling 30 days. What this basically means is how much Bitcoin has moved looking back over the last month. And so obviously when we look at 2011, 2012, 2013, you see these enormous volatile moves. Bitcoin during that period went from a few dollars to $1,000 back down below $200 over that 2011 to 2013 period. You see volatility spike also during 2017, especially at the end. You see it spike during the beginning of the pandemic in 2020. But what do you see since then? You see a quieting in Bitcoin's historical realized volatility. And that decline in realized volatility, that combined with the science around position size, suggests that Bitcoin with less volatility can take a way larger portion of traditional portfolios because they size it using historical volatility. Why is that? If you had 50% in your Bitcoin portfolio, if you had a portfolio of multi-asset and you had 50% of 50% of your portfolio in Bitcoin, and then Bitcoin goes down 80%, you have just lost 40% on your return. But if you do what BlackRock says and you put 2% in Bitcoin and it goes down 80%, you've only lost 1.6%. So 1.6% versus 40%, that's obviously a huge difference in risk. Now, today, if Bitcoin's volatility is much lower, the danger of a 20% Bitcoin allocation in a diversified portfolio, the risk of having 20% is much lower because you don't expect the 80% drawdown. Actually, just looking at the realized volatility, your max drawdown has decreased, which means that you can increase the size of your Bitcoin allocation. And so when we see vol drop over a medium or a longer term time horizon, volatility dropping is going to increase the first amount or the first purchase of Bitcoin in these portfolios. I'm talking about pension portfolios, strategic reserves at the state level, federal level, corporate treasuries. The lower the volatility, the higher the allocation is appropriate for a diversified portfolio. So lower vol is a very, very good thing for Bitcoin. Okay, so when BlackRock suggests 2%, you might see a standard traditional portfolio put 2% of their portfolio in Bitcoin as an opening position, as opposed to maybe 0.1% that might have been what they would have done 5 years ago. And so What we are expecting here is that as institutional adoption increases, the ETF AUM goes up and up and up. We should see volatility quiet. It doesn't mean you won't see 10 or 20K daily moves in Bitcoin. You still will, but zooming out and calculating the actual change, realized 30-day trailing, it's going to keep going down and down and down. By the way, I fully expect Bitcoin to make one of those 200 all the way back down to 150 or 200 all the way back down to 100 moves. You should expect that type of thing. I'm just telling you, expect the unexpected. As someone who's been in Bitcoin for about eight years now, I've seen all sorts of volatile moves. It was my expectation when Bitcoin was trading around 2,000 that one day you'll see a move from 60 to 40 and it'll freak everyone out. Well, that's the type of mentality that you should still have. You should think it's going from 200 to 100 or from 300 to 150, and that way you're less surprised when it happens. All right, I want to talk about what we offer at the Bitcoin layer for TBL pros. We have a research publication that's available to our pro subscribers, and those subscribers get my weekly letter. They also get a fantastic research report that we deliver called Mean Median Mode. It's a quantitative report that shows you what is moving Bitcoin. And what we've done is we've designed a metric. It's called TBL liquidity. And within TBL liquidity, we have the size of the banking system, interest rates, bond volatility, and the dollar versus other fiat currencies. All of these components move Bitcoin up and down. And so it's our goal to synthesize all of these other markets for you to give you signal. And what we've originated here is a metric with over 70% correlation to the S&P 500 and Bitcoin over a trailing couple year time horizon. So we've developed something very exciting. It's supposed to give you explanatory power. That's what we're trying to do. Explain why Bitcoin is moving and why. And that in that way, we can also do analysis on the individual components. Will the banking system increase or decrease? What about rates? Increase or decrease? And what about bond volatility? In that analysis, we are able to project what we believe the impact will be on Bitcoin. And we use this index, TBL liquidity here that you see in purple. I've lined it up with M2 for you. Now, M2 is a liability-based metric that measures deposits in the system, for example. So it's a money supply metric. But at TBL, we have an asset-based liquidity metric. It's not liability-based, deposit-based. It's bank-based, and what we're measuring is the ability for banks to create new money, to make markets, to provide that firepower for asset markets, risk assets, money creation, credit expansion, all of these things. So these are concepts that I'm writing about in my new book, Bitcoin Age, and that we're writing about them all the time at TBL. So go check out TBL Pro at thebitcoinlayer.com/subscribe to gain access to TBL liquidity. Now let's shift gears to politics for a second. A heartfelt congratulations to Ross Ulbricht and his family for the pardon that he received from President Trump. This was something that we were watching very closely because of the explicit promise made by Donald Trump during the campaign. This was a promise that he needed to keep in order to keep his support from a specific faction of Bitcoiners that have followed this story for over a decade. Now, I personally didn't live through the Ross Ulbricht era of Bitcoin. I was a couple years late to that. And so my emotion on the topic isn't as deep as others. So I would suggest people go out there, read what people are writing about Ross, read some of the people that were living through this era and felt incredibly wronged by what happened to Ross Ulbricht. So this is a special day for many, many Bitcoiners. Congratulations to Ross's family. Congrats to everybody that made the effort to promote a message of free Ross. There are a lot of people that deserve credit here. So we want to acknowledge that. And we also want to acknowledge that the significance of the promise kept is not lost on us. So for today, we're going to leave it with a celebration of a promise kept. But going forward, we will look for some of the other promises or policy stances that were announced in Nashville and other places during the 2024 campaign. We will continue to monitor those. And it does bring us a little bit of optimism. But again, we'll go one step at a time. And freeing Ross was definitely something that we value, we respect, and that we wanted to acknowledge. Now, going with what the new policies of the administration will look like for financial markets, we believe that the last couple days of price action are indicative of what we might see, which is a positive liquidity impulse from the administration. So what will create positive liquidity? Number one, bank lending. Number two, interest rates that are stable. Number three, bond volatility that is stable. And number four, a dollar that is stable, meaning not going up. Rates that are not going up. Bond volatility that is not going up. And so what is one of the ways that you can keep rates from going up? Bring down inflation. What's one of the ways you can keep the dollar from going up? You can stop rates from going up. And so there's signal that we got here from the first couple days of price action, which is that the market is viewing the policies of the new administration as not necessarily catastrophic for inflation. So looking at this chart, we have the 10-year yield. You see the 10-year yield right at around 4.5%. It's up against the highs of the last several years for sure, but it's not making new highs. And that by itself is important. If the stock market is making new highs, which by the way, it did today, we are recording this on Wednesday, January 22nd. The stock market, the S&P 500 made an all-time high today on the second or third day of the new presidency. But yields are pretty close to their highs of the last several years. What does that tell you? It tells you stocks can stomach rates at 4.5. Maybe not at 5, maybe not at 5.5, but at 4.5, they're at all-time highs. So if we can keep rates here or lower, it's going to be very good for risk. And that is the takeaway from the early price action. Where is the inflation scare? Where is the inflation worry? Show me on the chart, and you can show me once we're above 5 or creeping up to 5. Then you are seeing the worry, but below you're just not. Remember, we were worried about a recession below 4%, but we're not above 4%. We'll be worried about an inflation scare above 5%, but we're not worried about it where we are here at 4.5. So path dependency is important. The stock market has done great with rates where they are, even though it did terribly during 2022. You can see how rates went in 2022 from about 1.5 to 4. Stocks had a terrible year, but rates have basically now been flat for 2+ years. And that is allowing the stock market to digest. Of course, Bitcoin has done tremendously well over the last year, even though we've had rates where they are. So Bitcoin doesn't really care about rates at 4.5%. Neither does the stock market. That is signaled to us. Now, when rates were going up over the last few weeks and stocks were seeing some weakness, the dollar was getting stronger and stocks were seeing some weakness, what did we do? We looked between the lines. We saw bond volatility wasn't getting out of hand. So even though rates were going up, there wasn't a scare. And that's what TBL pros are getting. They're getting the bond volatility aspect and that type of analysis, and that's what we're covering in our report mean median mode. Now, I want to show you 10-year break-evens. Now, break-evens it's a backwards calculated rate. We have market rates, the 10-year yields, which we just showed you, 4.57%. We also have the TIPS yield, which is an inflation-adjusted yield. It's called the real yield. That TIPS yield that you get when you buy a TIPS security, it is a rate that you get added on to a backwards-looking CPI. So you get inflation plus this real yield. Well, if we take today's nominal yield, which is 4.57, and we subtract the TIPS yield, you get this break-even yield, which is what inflation is assumed to be based off of the two market yields. So remember, TIPS are the yield plus CPI, and that CPI calculation is basically what this number, break-evens, is telling you the expectation is going to be over the next 10 years. Now, where is inflation expectations over the next 10 years per the TIPS market? 2.38. You tell me if that is inflation scare. It's not. And above 2.5%, you'll start to get some worry. Going up to 3%, you'll get even more worry. Then you'll see liquidity get hit. TBL liquidity will take a dive, as will stocks, as probably will Bitcoin. So that's why we watch these types of metrics. And I want you to think about the most dangerous thing for the stock market and Bitcoin is high bond volatility. What's the scariest thing for bond market makers that cause volatility to spike? Uncertainty on every front. What I can tell you is that from the first few days of the new administration, there is some uncertainty on trade policy, tariff policy, but otherwise, there seems to be more and more certainty. I just saw a headline, Jamie Dimon in Davos, not guaranteeing, he said that we would love to lend money for the expansion of U.S. technological efforts, AI. He's talking about Elon. He's talking about Larry Ellison. He's talking about creating new money from JP Morgan for the expansion of investment. That investment has the potential to increase productivity. It has the potential to bring a second technology supply chain, which will protect the national interests of the country, even though it might, at the margin, increase the cost. But in the end, dual supply chains is something we've learned from Trump's new Chief Counsel of Economic Advisors, Stephen Myron, that the dual supply chain can be a deflationary force as well. So watch 10's break-evens, watch the 10-year yield, watch MOVE Index, and watch TBL liquidity for a beat on inflation, because the inflation itself will cause selling of fixed income. The selling of fixed income will cause damage to the ability for banks to make markets, sell products that allow tight spreads and allow for good hedging. All of this keeps risk going and keeps credit expanding. If you don't see stable bond volatility, you're going to see risk. You're going to see risk markets get hurt. That is what we have learned from our experience building TBL liquidity over the last year. Remember, thebitcoinlayer.com/subscribe. Go sign up for TBL Pro today. We believe it is an incredible value and something that you can use to help your own asset allocation process. Thanks for sticking with us today at the Bitcoin Layer. We'll catch you next time.